All right, so you know the old saying, buy low, sell high, right? Well, today we're going to flip that script and talk about something that could be very profitable, but it's definitely riskier. It's called selling stocks short.
Yeah, think of it like the other side of investing. Instead of betting on a stock to go up, you're betting on it to go down.
And to guide us through this deep dive, we've got a great source, How to Make Money Selling Stocks Short, by William J. O'Neill. He's the founder of Investors Business Daily, by the way, and Gil Morales, an experienced trader. It's part of the Wiley Trading series, so you know it's going to be packed with good stuff.
Right, and our mission today is to help you guys really get this whole short selling thing, when to use it, how to use it, but we're not going to get too bogged down in all the technical stuff.
Yeah, we want to keep it practical.
Yeah.
So let's start with the basics. What exactly is short selling?
Okay, so basically it's selling a stock that you don't actually own at the moment. You're borrowing it and betting that you can buy it back later at a lower price.
Okay, so let's say I want to short 100 shares of a company. It's trading at $50 a share. So what happens next?
All right, so you borrow those 100 shares from your broker and you sell them on the market at that $50 price. But remember, you have to buy those shares back eventually to return them to your broker.
Gotcha. So if the price drops to, say, $40 a share, and I buy them back then, I make a $10 profit per share.
Exactly, minus any fees or interest you owe on the borrowed shares. That's the ideal scenario.
Now, what if the stock goes up instead of down?
Well, that's where the risk comes in. If that same stock jumps to, let's say, $60 a share and you're forced to buy it back, you've lost $10 per share. And here's the thing, with regular buying, the most you can lose is your initial investment.
Right. The stock can only go down to zero.
But with short selling, there's no limit to how much you can lose because the stock price can theoretically keep going up and up.
Yeah, that's definitely something to consider. Now, the book talks about something called the plus tick and 0 plus tick rule. What's that all about?
Yeah, this was put in place to prevent people from aggressively short selling a stock and basically manipulating the price downwards. The idea was you could only short sell on an uptick.
So, like if the last trade was higher than the previous one.
Exactly, that's a plus tick. Or a 0 plus tick means the last trade was at the same price, but that price was higher than the one before it. It was all about making sure there was some upward movement before allowing a short sale.
So it's a way to kind of prevent a downward spiral. The book has a good example in Table 1.1. They list a bunch of trades. I think the sequence was like 54.47, 54.45, 54.46, 54.46 again, then 54.42, and finally 54.48. So you couldn't short at 54.45 because it was down from the previous trade.
Right.
But at the first 54.46, shorting would be allowed because it was up from 54.45. That's a plus tick.
Right, and then the next 54.46 would also be allowed. Even though it's the same price as the previous trade, it was still a 0 plus tick because the trade before that was lower.
Then 54.42, it's a no-go down tick. And finally, 54.48, you could short again because it was higher than the previous 54.42, so another plus tick.
Exactly. So, the specific regulations can change, but the goal was to prevent manipulation. Now, let's talk about when to consider this whole short selling strategy.
Okay, so O'Neill and Morales say the main thing is you need a bear market, which makes sense, right?
Right.
I mean, you're betting on prices to go down.
Yeah, they even have a rule, cardinal rule #1, to sell short only during what you believe is a developing bear market, not a bull market. Because in a bull market, most stocks go up, so shorting is a tough game.
So you really have to be able to recognize those market tops.
Yes, and understand the overall trend of those major averages like the Dow Jones Industrial Average, the S&P 500, and the NASDAQ.
Right. Being able to spot that shift from a bull market to a bear market is super important if you want to make money short selling.
Exactly, and they talk about these things called distribution days, which can be an early sign that a market top is forming.
Okay, what are distribution days exactly?
Think of it like the big players starting to sell their shares. It's a day when the market index closes lower but on higher volume than the previous day. So it means there's more selling pressure despite the lower price.
So it's like a subtle shift in the market.
Yeah, and they give the example of the 1984 market peak. They show the Dow Jones in chart 1.1, and you can see these distribution days happening over time, the index slowly declining but with higher volume, and then bam, a big drop.
So it's not just a one-off thing, it's a pattern.
Right, and they show similar patterns for the 1990 Dow Jones top, chart 1.2, and the NASDAQ Q top in 2000, chart 1.3. So this is something that keeps showing up.
Okay, what about failed follow-through days?
Yeah, so after a market decline, you often get these rallies, right? A follow-through day is when, usually on the fourth day or later after a potential market bottom, the index closes much higher on increased volume, suggesting that the rally has legs. But a field follow-through day is when that rally stalls and the market starts going down again.
So it's like the bulls try to push it up, but they can't quite make it.
Exactly. Like the NAS day in 2002, you can see in chart 2.1, there was a follow-through day, but it failed and the market kept going down. They have a similar example with the S&P 500 in 1982. Chart 2.2. So you're looking for confirmation of a rally, but if it fails, that's a bearish sign.
Okay, so we know what kind of market we need. Now, how do we pick the right stocks to short?
That's the fun part, right? So O'Neill and Morales say that stocks that have shot up in price, those are often good candidates.
The idea is what goes up must come down.
Yeah, those big price increases can sometimes mean a stock is overvalued, so it's more likely to correct. They also talk about these things called failure-prone bases. You see in the world of stock charts, a base is when a stock kind of consolidates before potentially going up again, like it's gathering strength.
Okay, so what makes a base failure prone?
It's all about the details. Like if a stock has already formed several bases and had a big run-up, those later bases are more likely to fail. Imagine a runner in a race. The more sprints they've already done, the harder it is to sprint again.
They get tired.
Exactly. And then you have those cup-like bases with bad handles. The handle is like a little dip in the base. It should be small and near the top of the cup. But if it's too big, too wide, or near the bottom, it means the stock is weak.
And the book has some great charts to illustrate this.
Yeah, like Calpine Corp, chart 3.1, six-stage base, breaks down. Then you have Numerical Technologies, chart 3.2, with those V-shape recoveries, bad base structure. Applied Microcircuits, chart 3.3, the handle's just too low. And Charles Schwab Corp, chart 3.4, more bad cup formations. You see these on a chart, and it's like a warning sign.
Okay, I'm starting to get the visual here. What about climax tops?
Oh, yeah, a climax top, that's when a stock goes up like crazy, huge jumps, big volume. It's like the last burst of energy before it crashes.
It's running out of steam.
Right, and it's usually fueled by speculation, so it doesn't last. They have some examples from the dot-com bubble, HGSI, QCOM, AOL, charts 4.1, 4.6. You see these almost vertical lines going up, and then boom, the price drops.
Okay, so we know when to think about shorting. We know what kind of stocks to look for. But what are some general guidelines to keep in mind?
Okay, so one important one is focus on stocks that are already going down. They should have broken below their 50-day moving average. That's a good sign the trend has shifted down.
So you're not trying to catch a falling knife.
Exactly. And as for timing, they say the sweet spot is usually 5-6 months after the stock hits its peak.
So you let the initial excitement die down.
Yeah, and then you want to avoid those low capitalization companies or stocks with very thin volume. They're volatile and prone to short squeezes, which is when the price suddenly jumps up and forces short sellers to buy back at a loss, which drives the price even higher.
Ouch, that sounds painful. They also say not to rely solely on oversold indicators, right?
Yeah, those can be helpful, but they're not the whole story. You have to look at the bigger picture, the price action, the market context.
And what about institutional sponsorship?
Well, if the big institutions aren't buying or even selling, that's a red flag. Without their support, the stock is more likely to go down.
Makes sense. They also mention industry group rankings. What's that about?
Well, it's easier to short a stock if the whole industry is struggling. If everyone's having a tough time, individual stocks are more likely to fall too. They have a table 2.1, that shows how to track industry group performance.
So you can see which sectors are weak.
Exactly. And then finally, they say common sense should prevail, which is good advice in general. Look for companies with real business problems, especially those in industries that are cyclical, meaning they go up and down with the economy. It's not just about chart patterns, it's about understanding the business.
Yeah, that's a good reminder. Okay, we've talked about the when and the what. Now let's talk about the how, the anatomy of a short sale. What kind of chart patterns should we be looking for?
All right, so one classic pattern is the head and shoulders top. They have a good diagram 1 that shows it. It basically looks like, well, a head and shoulders.
Okay, how do I spot it on a chart?
So you'll see 3 peaks. The middle one is the highest, that's the head. Then you have the left and right shoulders, they're lower peaks on either side. And then you draw a line connecting the lows between those peaks. That's the neckline.
And that's where I should short.
Well, you want to wait for the price to break below that neckline, and ideally on high volume that confirms the breakdown. And they show in the diagram there was a previous support level. That's a price where the stock bounced up before, and when it breaks below the neckline, it's like that support has failed, so the price is likely to keep going down.
Okay, so what about late-stage base failures? You mentioned those earlier.
Yeah, so remember, a late-stage base is one that forms after the stock has already gone up a lot. A late-stage base failure is when the stock tries to break out of that base, but it can't. It might go up a little, but then it falls back down.
So it's like it's losing momentum.
Exactly, and these failed breakouts, especially if they happen a few times, can be great shorting opportunities. They have a good example in diagram 2. The stock tries to rally above its 50-day moving average, but it fails, and then it breaks down through the base.
Okay, so besides those big patterns, are there any smaller clues that can tip us off?
Oh yeah, they mention a few. One is what they call stalling, where the stock closes below the midpoint of the previous week's range for several weeks in a row. It's like it's running out of steam.
Losing momentum.
Right, and then you have those wedging rallies on low volume. A wedge pattern, that's when the price goes up, but the highs and lows are getting closer together, and if the volume is low during those rallies, it means there's not much buying conviction, so it's likely to fail.
They also use the term railroad tracks. What's that?
That's when you see a big up week followed by a big down week, and it usually happens on high volume. It's a sign that big investors are selling, getting out. And then finally, you have island tops, which is when the stock gaps up, trades in a range, and then gaps down, leaving that trading range like an island on the chart. It's a big sign that sentiment has changed from bullish to bearish.
Lots of visuals to look out for.
Yeah, and one last thing. They really stress setting a price limit for your short sale order.
What's the reason for that?
Well, it gives you control. In a fast-moving market, especially if the stock is volatile, you don't want to end up shorting at a much worse price than you intended.
So it's about managing risk.
Exactly. A limit order protects you from slippage, which is when you get a worse price than you expected.
Okay, so we've covered a lot of ground here. The when, the what, the how of short selling. But a big part of the book is dedicated to real-world examples. I mean, they talk about everything from Boeing in the 1960s to Wendy's in the late 70s, Micron Technology in the mid-90s, Sienna Core in the early 2000s, Namtai Electronics more recently, just to name a few. What's the main lesson we should take away from these examples?
Yeah, they have a ton of examples. The main point is these examples show everything we've been talking about in action. You see the chart patterns, the market context, the timing, it all comes together.
So it's like seeing the theory in practice.
Exactly. And the fact that they have examples from so many different time periods and industries shows that these principles, they work.
Right. It's not just a fluke, it's a repeatable process.
Yeah, studying those examples can really help you learn to spot good shorting opportunities and develop your own judgment. It shows that short selling, when done right, isn't gambling, it's a skill you can learn.
Right. So to wrap it up, it seems like short selling can be a good way to make money, especially in a bear market.
Yeah, but it's not without risk.
Definitely not. You have to be careful. But if you can identify a bear market and find stocks that are showing signs of topping out, like with those head and shoulders patterns or late-stage base failures, there's potential for profit.
Right, and remember those guidelines. Focus on stocks that are already trending down. Avoid those thinly traded companies. And risk management is key, using stop-loss orders to limit potential losses.
Yeah, that's super important. So while most people focus on buying and holding, it's clear that understanding short selling can be a valuable tool, even if it's riskier. It really makes you wonder what other unconventional strategies are out there.
Right, that's something to think about.
It definitely is. Well, that's all the time we have for today's deep dive. Thanks for listening.